First up, we have Skipper. The company posted an overall good set of numbers in the fourth quarter. They reported their highest ever quarterly revenue and profit. And this is after a sharp uptick that they got, or rather ably aided by the uptick in their other income as well. Sharan Bansal, who's the director of Skipper, joins in to discuss the quarter gone by in more detail. Sharan, let's start with FY26, the basics. FY25 saw a revenue growth of 41%, record revenue coming in from both engineering and polymer segment. What is your guidance in terms of revenue and margins for FY26 from where you look at things right now?
Hi, Mangalam. Yes, we've definitely had a very good year and quarter. Back in FY23, we had taken on a target to double our revenue in 3 years' time, and I'm happy to report that we have been able to achieve that in just about 2 years. Going forward, even on this elevated base, we feel there are very, very strong opportunities available in the market. The company is carrying an order book of 7,000 crores plus. So based on the order book, looking at the market opportunity as well as our capacity expansion, we feel that 25% revenue growth from here on as well, and for the subsequent years also, should be very much possible.
Okay, 25% plus growth. Congrats, Sharan. I recall speaking to you a couple of years ago or so, and at that point of time, you had put out big guidance. And as you're saying, you're maintaining that. So good on you. But let's get a couple of more details. Profitability, is still hovering around that 10% odd mark. Should this be the range that we should be working with? And the other positive, that I would like to highlight besides the revenue growth in your numbers is that the working capital days have come down. Is it sustainable? Can it get even better?
Very good point, Nigel. And yes, the profitability, we do expect that there's headroom to grow. One reason is that we are going to see much more revenue coming from T&D now than our non-T&D revenue. Non-T&D historically has been a lower margin business for us. So both in terms of bottom line as well as working capital, we expect the coming year to be even better than what we've delivered. On the working capital side, yes, we have made some improvements. There are certain more optimization that we can achieve, both in terms of inventory as well as working debtor number of days.
So can you talk about the margins? I mean, how much more can margins improve? And since you spoke about T&D, what is the contribution of T&D to your revenues right now? Where does that go? What's the margin differential between T&D and others?
T&D revenues now in the coming year will be 80% plus for us. So you can say majority it will be T&D, and normally non-T&D revenue is about a couple of percentages lower than T&D. So that's where we are looking to go ahead.
All right. We missed the margin number. We would like you to give us a broad range. What can that look like? And you're saying there's scope for improvement on working capital days. Sharan, we love numbers. Give us a number. What should we work with?
I think on a net basis, on the working capital, we are at just about 90 days right now. We feel that there is scope to bring this down by another 10 to 15 days in the coming year itself. And in terms of margin guidance, of course, look, I would love this to become 12% overnight. However, long term, we do have an aspiration to get to 12%. Now, how soon we get there, again, it's a matter of time.
All right. You've recently secured a multi-million-dollar order in the US as well. If you could give us some details around that. And also, the larger point, there is a fair amount of uncertainty for exports to the US. How much do they contribute to your overall revenues, and would the tariffs impact you?
Good question. Currently, the US is a very small portion of our order book and revenue. We have secured our first medium-sized order from there, and we are expecting larger inflows from that market. We don't see tariffs as a negative for us. Rather, we believe that the ongoing trade tensions between the US and China will open up further opportunities for players like us and for products like us, which are non-commodity, and there are high amount of engineering and labor component. We certainly feel the opportunity is only growing for us long-term in the North American market.
So if you could give us some numbers around here as well, how much does US account for in your overall scheme right now? Because exports is just about 12% of your order book. You won some orders from the US. How do you intend to take that forward?
Let me put it this way, that currently our export order book is just about 12% of our overall order book. And obviously, the US is a very, very insignificant portion of that. I'd like to club the US along with other developed markets where we are focused on, which is Europe and Australia. For our overall exports, the target is to take it up to 50% of our order book over the next 3 to 4 years. And out of that 50%, we would like 50% to come from these developed markets, which is North America, Europe, and Australia. So I'd like to give a guidance in that sense, and that is the opportunity that exists in all of these developed markets thanks to the growth of renewable-led power transmission.
And if I remember correctly, these businesses from developed markets give you relatively better margins.
For sure.
Okay, all right. Let's wind this down then with a couple of more details. You have some capacity that's coming on stream, I think 75,000 tons or thereabouts. So do you believe that demand is strong enough to absorb this? Point number one. Point number two, what kind of capex number can you guide for the year? And the third point is, where does it take your debt to? So on the additional capacity, the capex and debt. Please go ahead.
Okay. So in terms of additional capacity, yes, we've done capex last year as well. So we have about 75,000 tons of new capacity coming online in Q1 this year. That will take our capacity to 375,000 tons. We are looking to add another 75,000 in this financial year, taking us up to 450,000. In terms of capex, we expect to spend similar amount what we spent last year in the range of 200 to 220 crores. And in terms of demand, we believe that there is a very, very long runway, and we are seeing the beginning of an investment super cycle in power transmission. So honestly, look, the market looks good for the next 10, 15, 20 years. We believe that even if we continue to grow, and our aspiration, as I mentioned earlier, is to become the largest manufacturer for T&D structures globally, which will happen over the next 3 to 4 years, we will see enough of a demand scenario over the next 10, 15 years to take care of this enhanced capacity.
What about your debt? Because your net debt is up nearly 31% from 440 crores to nearly 600 crores. Then you have around 220 crores of capex coming in as well this year. What happens to that? What's the deleveraging plan here?
I think what will happen is that, so again, we have strong cash flows to make to take care of whatever capex we are doing. If you look at our net debt number and add interest-bearing acceptances on that, then you would see that actually that there's been a reduction over last year. So compared to about 1,200 odd crores, we've actually brought it down to 1,100 crores for the net debt plus acceptances number. And like I said, that's come on the back of our improved working capital cycle. Further improvement will help in further deleveraging on an overall basis. In terms of long-term debt, we don't have a lot of long-term debt, so we're fairly comfortable, in terms of the debt equity that we are maintaining, which is below 0.6 right now.
And so comfortable on the debt aspect, do you see any need to raise some equity, capital? Because I have my ear to the ground, and sometimes, the rumor is that maybe, in fact, Skipper could be looking at tapping the markets. Any truth, or do you want to downright deny it?
I would rather say that, look, we don't have any urgent need for equity. As I mentioned, the company has strong cash flows and internal accruals to make sure that our growth plans are intact and they are comfortably met. At the same time, we're always open to good quality investors coming on board as part of our investor book. We have some good quality FIIs who are invested into the company today, and we're always open to inviting more and more good quality investors in the book.
Sharan, any conversation as of now? Have you received some interest? Say in the coming year, could we see some equity infusion?
No, I'm sorry. There's no nothing on the immediate horizon which I can share with you.
All right, take that point. Thank you so much, Sharan, for joining in and giving us those details. 25% revenue growth on a 41% base this year with improving margins, the long-term target being 12%, currently around 10% as well, and capacity increasing over this year and the year after by almost 50%, something that we'll most definitely keep an eye out on. The stock up 7% on the back of those results.